Now that we've seen how mixing different assets in a portfolio can contribute to reducing the overall risk and volatility of that portfolio, we can make the case for diversification. Here's a question for you. Is it possible to fix a target return and reduce volatility of a portfolio by adding assets with low correlation with the portfolio? The answer is yes. In the too risky asset example, we saw that by mixing stock A with stock B, we were able to generate portfolios all along this hyperbola curve here, including the minimum variance portfolio, which has a much lower volatility than either stock A or stock B. We were also able to pick a portfolio at this point of the curve, called the tangency portfolio, and mix it with the risk-free asset to create portfolios all along the capital allocation line. This means that we could choose a portfolio at this point of the line, which has a similar return than our stock A, but much lower volatility. So stock A has part of its risk or volatility that we can easily diversify, and there should be no reward for bearing this part of the risk. But there is part of this risk that we cannot diversify. We cannot bring it all the way to zero. There's no portfolio here to choose from. We can think of volatility as total risk of an asset, which has a part that we cannot diversify and a part that we can diversify and eliminate. The part that we cannot diversify is often called systematic risk, and it relates to the overall economy risk. Whereas the part that we can diversify is called idiosyncratic risk and relates to either firm or industry specific risk. There should be always a premium for bearing the risk that we cannot diversify, and there should not be any premium paid for risk that we can easily diversify. The economist Eugene Fama gave us a great example to explain diversification in his 1976 book, Foundations of Finance. He calculated the expected return and standard deviation of a portfolio of N assets, assuming that all the individual assets have the same expected return and same standard deviation. The expected return of the portfolio is a constant, since all the individual assets have the same return. But what is more interesting is to see what happens to the variance. Here we have a plot where the x-axis is the number of assets in our portfolio, and the y-axis is the variance of the portfolio. We can see that by adding assets to the portfolio, the variance reduces rapidly, following a rational function shape here. But there is a limit, which is the constant of this equation here. So this variance we cannot eliminate by adding assets to the portfolio. And this part of the equation relates to what we mentioned before, the systematic risk. And there should be a premium for bearing this risk. Whereas the second part of the equation, which we can basically eliminate by adding assets, relates to idiosyncratic risk, and we should receive no premium for bearing this risk. Empirical data shows that portfolios with more than 20 assets, which are randomly selected, should be almost completely diversified, meaning the idiosyncratic risk in these portfolios should be close to zero. I hope that after seeing this example, you can better understand asset and portfolio risk, and that you truly appreciate the benefits of diversification.